Mackenzie Johnston with Cattle News Central, bringing you your January 7th cattle industry headlines, brought to you by Ag Risk Advisors. They provide risk management programs to livestock producers all throughout the West. Whether you are concerned about weather or price risk, Ag Risk Advisors, they are here to help. With current day market fluctuations, there is nothing more important than locking in a price floor on your cattle. So if you would like to learn more about an LRP, go ahead and reach out to an advisor today. Also sponsored by American Beef Producer Magazine. ABP Magazine offers in-depth articles concerning various topics within our industry. They feature award-winning photography and so much more within their magazine. If for some reason you are not already subscribed to ABP Magazine, head on over to their website, abpmag.com. On their homepage, there is a large subscribe button up in the top right-hand corner. You go ahead and click on that and they will get you all fixed up. American Beef Producer Magazine, guiding beef producers for over 25 years. According to Shaylee Stewart with DTN Progressive Farmer, as 2021 turned into 2022, cattlemen were faced with a rude awakening as the market's smooth sailing came to an end. On Tuesday, within a few short minutes of the market trading, feeders spiraled downward anywhere from $3 to $4, while the corn market shot up 16 cents to 20 cents higher, and soybeans increased anywhere from 30 to 34 cents. The grain market's rally was mostly influenced by poor weather conditions down in South America. Both Brazil and Argentina are desperate for moisture, so most likely their crops, they're going to be below average, which means that U.S. crops could have a bumper year due to strong export demand. So there are both positives and negatives that come along with increased feed costs that will go hand in hand, of course, with increased cost of corn. First off, higher corn will likely influence feedlots to market the pens of market-ready cattle at lighter weights. Based on most recent actual slaughter data released by the USDA for the week ending December 18th, 2021, steer carcasses averaged 924 pounds, which was 5 pounds lighter than the week before. However, that weight is still 3 pounds heavier than the same week back in 2020. Heifers averaged 850 pounds, which was 1 pound lighter than the previous week, but still 3 pounds heavier than the same week a year ago. Stewart went on to touch on the cattle inventory report that will be released later this month. There is no doubt that we will see a significant drop in cow numbers, which of course is good news for cow-calf producers amid such high beef demand. But if carcass weights sustain their current trajectory and continue to pressure the market, what happens if something goes wrong with production levels and packers run at slower chain speeds? If something would actually go wrong, the additional tonnage would of course cause a glut in the market like we've seen, and again we would have a backup of cattle supplies, which would diminish the rally that the cattle market could have if feedlots were current. The next point to consider is that high corn prices, they can be stomached as long as cattle contracts rally right along with them. We all know the saying, high corn makes for high cattle. According to Stewart, when we look back at history, the cattle contracts have traded in an inverse manner to the corn market. And as we all know from a day-to-day perspective, feeders are heavily influenced by what the corn market is doing. But if we look back at recent years, the cattle complex has become less reactionary to the corn market's sporadic trading, and we have found that long-term corn prices can influence cattle prices to actually trend higher. At the end of the day, the major issue with corn prices is that they pressure feedlots' cost of gains, as we all know. These higher corn prices are felt even more during a period of drought, which we are currently experiencing. Finding a way to feasibly feed cattle is becoming more and more difficult. Stewart closed by reminding everyone that there are plenty of bullish factors to consider heading into this year, but there will undoubtedly be some curveballs thrown at us in 2022. CNBC has reported that starting on Monday, KFC restaurants all across America will begin featuring Beyond Meat's plant-based chicken on their menu for a limited time. KFC believes this is the best time to roll out this option, as many consumers are looking for healthier options to sustain their New Year's resolutions. Studies show that more and more Americans are following a so-called flexitarian diet, which requires less meat consumption for health and environmental purposes. This trend is obviously giving plant-based substitutes a boost. So to prepare for other product launches, coming this year, Beyond Meat took it upon themselves to snatch up some Tyson Foods veterans. They added Doug Ramsey as Chief Operating Officer and Bernie Adcock as Chief Supply Chain Officer. Some background on these gentlemen. Ramsey spent 3 decades with Tyson overseeing its poultry and McDonald's businesses. Adcock also worked for Tyson for 30 years, focusing on operations and supply chain management. Going forward, Beyond is hoping to get their stock back on track. In the last 12 months, their shares have lost half of their value, which has caused the company's value to dip all the way down to $3.9 billion. That is all I have for you guys this morning. That is all I have for you this week. I hope you guys are surviving this cold. It looks like it's going to get better here in the next few days. You guys have a wonderful weekend. I'll see you next week.